So, a study came out in January of 2023 looking at Social Security for long live retirees, and it basically came to the conclusion that the vast majority of the time, retirees are better off delaying their Social Security benefits. So, I want to break down that survey for you today, or that study for you today, and kind of think about how it might apply to your claiming strategy for Social Security benefits. My name is Scott Caulfield. I'm a CPA and a CFA charter holder, and I'm the founder of Sophos Wealth Management. So, this study was done by Wade Pfau and Steve Parrish. It was called "Which Social Security Claiming Strategy Generates the Highest Legacy Value?" And it came out in the Journal of Financial Planning, again, like I said, in January 2023. Now, what they did is they looked at two different scenarios. One was a single individual, and they assumed he had an investment portfolio of around $1 million, and the other was a married couple with an investment portfolio of $3 million. And in both cases, the portfolios were split between pre-tax and post-tax retirement dollars, so IRAs and taxable individual accounts. And they kind of compared what would the lifetime benefit look like if they retired at 62, or if they took Social Security benefits at 62 versus taking them and delaying them until 70. Now, when you take retirement benefits, Social Security, before your full retirement age, you get a reduction. And if you let them grow all the way till 70, you get an increased benefit. Now, what they did is they assumed that those investment portfolios would be allowed to grow. And they did different allocations, 25, 50, 75% into stocks, with the remainder into bonds. I think it's the US 10-year Treasury was kind of the proxy for bonds. Then they looked at historical scenarios, and they looked, when would a retiree be better off? Now, one of the key parts of the study is they assumed in both cases the retirees would live till 95. And they wanted to figure out how often would you run out of money and how much would the legacy value of the portfolio be worth at 95? Meaning, what is your net worth at 95 when it's presumed the retiree would pass away, and how much would they have to leave to heirs, charity, so on and so forth. So let's look at the first chart here on the actual case study results. This is for the individual with the $1 million portfolio. And what you're seeing is the difference between claiming benefits at 70 versus 62. So anytime the line is above 0, then claiming at 70 and delaying was the better result historically. Anytime it's below 0, claiming early resulted in a better scenario. And what you'll find is there's only really 3 major periods where claiming early paid off better for this retiree. And typically that was associated with really strong initial stock market returns. So 1980, 1919, and the 1870s, 1880 period. Now, what they showed is for this single individual, he would have been better off 76.3% of the time delaying till 70 as opposed to taking those Social Security benefits early at 62. That's essentially the exact same findings they had for the married couple. 77.1% of the time, the married couple was better off taking those retirement benefit or delaying those until 70. Now, one of the other things that they were kind of looking at here, which is important to note, is thinking about those Social Security benefits as sort of a insurance against living a long time. So the concern is if you have a really, really long life and you end up living quite a bit past normal life expectancy, there's a concern that some people might run out of money. And if you look at the second figure from their study, they basically show all the historical scenarios and where you ended up at the age of 95. And the lower left quadrant is kind of some of the worst case historical scenarios. And if you look at those who claimed at 62, what you'll find is there were quite a number of scenarios in which the retirees ran out of money when they claimed their Social Security early. So they'll still get Social Security when their investment portfolio runs out, but they will have nothing that they can withdraw on anymore at the end of life, nor will they have anything to pass on. And obviously that can be a significant problem for people, especially because you often run into high healthcare costs and other things at the end of life. That was not an issue for those who delayed Social Security till 70. So the study's authors kind of claim, hey, there's a kind of an insurance type value in delaying those Social Security benefits. And for both the single individual and the married couple, again, the results are pretty similar here. What they found is there was an 8.5% failure rate for those claiming Social Security at 62. So 8.5% of the time, those who lived till 95 ran out of money on their investment portfolios. So very interesting results. For a lot of those conservative people who think they may live well past sort of actuarial life expectancy, you might consider delaying those Social Security benefits. However, this study misses a couple things. I shouldn't say misses, but you need to take a few more things into consideration. So they're assuming somebody lives till 95 in this study. So if you live till 95, 76% of the time, you would be better off delaying Social Security. What if you live till your early 80s? The actuarial life expectancy is anywhere from like 82 to 86 for men and women near retirement age. So if you were only to live there, the vast majority of the time, the portfolio value would be better if you claimed Social Security early and invested the difference. So that's going to really change kind of the calculus. How long do you think you will live? The other thing is that this assumes that these retirees have smart investing behavior. So the numbers I gave you were based on a 50% stock allocation, and that those were going to be rebalanced at the end of every year. A lot of retirees and a lot of investees don't behave so responsibly. They put too much in equities when things have done well, and then future returns end up poor. And then they take all their money out of equities when they've done poorly, but are set up for great future returns. Think about 2008-9. A lot of people panicked, took all their money out, and they missed the great returns going forward after that. So a lot of people in practice don't have these kind of idealized investment returns. That being said, if you do, and you're not going to live past the actuarial age, the better scenario actually would be to take Social Security earlier and invest it just from a purely financial standpoint. But as always, these things get really complicated. So much depends on your individual scenario. What do your investment assets look like? What sort of tax situation are you in? Are you able to maybe do some tax planning, taking capital gains earlier when you don't have a lot of high taxes to pay, or maybe no taxes, depending on what your overall adjusted gross income is? There's all kinds of financial planning that can come into account with when to take Social Security. So it can be quite a complex topic. Always happy to discuss your situation. If you want to reach out for a free consultation, and please like and subscribe and share this with anyone you think would benefit. Thanks a lot.